Thank you for joining us. Today's presentation features Ron Temple, co-head of multi-asset and head of U.S. equity. Please note the information and opinions discussed do not constitute investment advice. Any securities mentioned are not necessarily held by Lazard Asset Management and should not be considered a recommendation or solicitation to buy or sell those securities. All opinions expressed are subject to change. With that, I'll hand it over to you, Ron.
Thank you for joining us today for a discussion of global trade tensions and the implications for the economy and investors. Today I will review the current situation and the outlook for the trade war. Trade tensions have escalated substantially in the last year, both between the U.S. and China, as well as between the U.S. and its other key trading partners. While it took some time, we are now able to see the effects of the trade war with China in particular in the economic data, including the redirection of trade from sources in China to other emerging economies. While the trade dispute with China began as an economic disagreement over trade deficits, it evolved over time to cover market access, industrial policy more broadly, intellectual property protection, and ultimately national security. The evolution to the military security arena is particularly problematic, as it is to some degree a non-negotiable matter to both China and the U.S., and hence may preclude the ability to reach a comprehensive agreement to resolve trade issues. To the extent a narrow deal is agreed, I would recommend being highly skeptical of the scope and duration of such an agreement, as the narrative of China as a national security threat has become much more embedded in the discussion in Washington, D.C. on both sides of the political aisle. All of this combines to increase uncertainty in terms of the economic outlook. Uncertainty is the enemy of growth and leads to increased recession risk in 2020, although recession is still not the base case scenario. From a high level, it is useful to remember that the U.S. is engaged in a multifaceted trade dispute. On the left-hand column, we have listed policies directed at China, while the right-hand column relates to other parties other than China. You can see that in both columns, the U.S. has either threatened or actually implemented tariffs. In the case of the other trade partners, the U.S. has reached broader trade agreements in the case of South Korea with KORUS, Mexico and Canada through USMCA, which is still not ratified by Congress, the USJTA with the U.S. and Japan, which has reached a preliminary agreement, and the U.S.-European Union trade agreement, which is still in the early stages of negotiation. In the case of China on the lower left box, I would highlight that the action so far has been primarily in the form of tariffs, but also has extended to restrictions on trade with specific entities such as Huawei and ZTE. Importantly, given the national security facet of the dispute between the U.S. and China, I expect to see more restrictions on trade, particularly related to technology equipment and services in the years ahead. Here you can see that 45% of U.S. imports from all trading parties are currently either subject to or threatened by tariffs. The graph shows the estimated dollar amount of tariffs being applied to imports into the U.S. The solid blue shows that the annualized run rate now exceeds $80 billion of tariffs on approximately $304 billion of goods. Assuming all of the tariffs that have been threatened to date are actually imposed, this figure would more than double to $180 billion per year of tariffs on approximately $766 billion of goods from our global trading partners. Our trading counterparts have responded to the U.S. tariffs by imposing their own tariffs on U.S. exports. So far, however, retaliatory tariffs imposed by our global trading partners have been much smaller than U.S. tariffs on imports, with the global total at a run rate of just over $20 billion of tariffs per year on U.S. exports. If all threatened tariffs are implemented globally, this figure would rise to $28 billion per year of tariffs. Focusing now on China in particular, you can see the categorization of goods subject to tariffs in each incremental wave of tariffs. List 1 tariffs of 25% were imposed on July 19th of 2018 and are currently scheduled to increase to 30% on October 15th of 2019. List 2 tariffs of 25% were imposed on August 23rd of 2018 and likewise are scheduled to increase to 30% on October 15th of 2019. List 3 tariffs of 10% were imposed on September 24th of 2018. They were subsequently increased to 25% in May of 2019 and are scheduled to increase to 30% in mid-October 2019. List 4A tariffs of 15% were imposed on September 1st of 2019 and List 4B tariffs of 15% are scheduled to be imposed on December 15th of 19. Now, List 4 is basically all Chinese exports to the U.S., excluding pharmaceuticals, certain pharmaceutical inputs, select medical goods, rare earth materials, and critical minerals that had not been subject to tariffs until September of this year. Now, the key point of this chart is to show that the Chinese exports to the U.S. that are subject to tariffs have shifted. Initially, the tariffs were almost all imposed on intermediate and capital goods that are purchased by companies. These tariffs took time to work their way through the supply chain, and in some cases were not visible to end consumers, as companies found ways to offset the cost pressure either by negotiating lower prices from Chinese suppliers, taking advantage of a weaker Chinese currency, or through other unrelated cost cuts. However, the latest tariffs imposed on September 1st hit $60 billion of consumer goods. The September 24, 2018 tariffs also did hit consumer goods, but with a 10% tariff versus the 15% imposed in September of 2019. As such, the optics and substance of the trade war may well start to hit U.S. consumers more directly in the fourth quarter of 2019 as prices on the shelf at Walmart and other retailers increase in response to the List 4A tariffs. More specifically, the List 4A tariff shown in gold hit apparel the hardest, with $25 billion of imports subject to the 15% tariff. Other key categories affected on September 1st include $10 billion of computers, $10 billion of consumer electronic goods, and $9 billion of toys, sporting goods, and other similar items. The big item for List 4B in mid-December is $47 billion of smartphones shown in black in column 1, and $38 billion of computers in column 2 on this chart, which are scheduled to hit on December 15th. Looking at global trade more broadly, there is a clear pattern of trade aligning with the global industrial cycle. The industrial slowdown in 2015 and 16 is apparent, with trade growth decelerating from 5% to 0%, before rising again when the synchronized global recovery was in play in 2017 and early 2018. The more recent deceleration also aligns with an industrial slowdown, but also with the trade war. I would note as well that if we extended this chart back in history, global growth in trade has decelerated substantially since the global financial crisis, as it appears that many companies might have exhausted the opportunities to offshore their supply chains after very rapid globalization from the 1980s through 2005. Now, much of this globalization of supply chains was actually through related entities in which the importer actually owned part or all of the exporter overseas. That structural globalization story has partially reversed since 2009, with the recent trade situation adding to the headwinds for globalization. As the trade war has escalated, we have seen a somewhat predictable reaction from American importers. They have shifted their supply chains away from China to other low-cost foreign producers who are not subject to tariffs. Here you can see that imports from China are down about 5% year-on-year over the 12 months ended July 2019. At the same time, imports from Vietnam are up about 23%, and from Taiwan are up over 15%. If we drill down into two specific product categories, you can see that for telecom equipment on the left, imports from China have declined sharply, as shown in green, while imports from Vietnam, shown in red, have increased materially. On the right chart, we show similar information for computers, where imports from China, shown in green, have contributed to a sharp reduction in overall imports, while imports from Taiwan, shown in red, have increased, along with those from a number of other countries. Looking forward, we have provided a number of key dates to watch for news on the trade front. I would highlight the pending Export Control Reform Act, ECRA, consultation, which has been expected for several months, but for which we do not have a precise date. Now, ECRA, the Export Control Reform Act, is a very important part of legislation passed under the National Defense Authorization Act in August of 2018. The U.S. has had long-standing regulations on the export of sensitive technologies. However, the Export Control Reform Act mandated that these regulations be updated, with a focus on both emerging and foundational technologies. Unfortunately, as is typical, the legislation did not define precisely what the parameters of emerging and foundational technologies are. As a result, there's a justifiable concern that these parameters will be defined in a way that is excessively broad given the escalating economic and security tensions between the U.S. and China. If that occurs, this could significantly impair the ability of U.S. technology and telecommunication companies to do business with certain foreign countries, most importantly China. We still do not have a definitive date for the next round of U.S.-China trade talks, but have an indication that they should begin in early to mid-October. On October 15th, the U.S. is due to increase tariffs from 25% to 30% on the products covered under List 1 through 3. November 14th is the most important date related to autos and auto parts, as that is the deadline for the Trump administration to determine whether it will impose tariffs on imports of autos and auto parts into the U.S. While total imports of autos and auto parts are just under $300 billion, we would expect tariffs to exclude the roughly 50% of total imports from Mexico and Canada, with the brunt of tariffs on the European Union. Finally, on December 15th, the List 4B tariffs are scheduled to be implemented on about $180 billion of products, including smartphones and computers. When I think about scenarios for how the trade war is likely to play out with China in particular, I think there are four broad possibilities for the trade talks. I should note that even if the U.S. and China reach an economic deal regarding trade, I still believe the view of China as a national adversary rather than an economic competitor is critical to keep in mind and is likely to mean that tensions will remain elevated for years to come. Now, having said that, in terms of the near-term trade talks, I see the chances of a broad deal that is comprehensive being very low at about 5%. There are two reasons for being so pessimistic. The first is that certain aspects of the dispute are likely to be seen as non-negotiable for China. For example, China's industrial policy has been fundamental to its economic model and growth for decades. Secondly, the more hawkish elements of the political elite in both countries are unlikely to support any comprehensive deal at this point, and are likely, in the U.S. case in particular, to accuse any deal of being too weak. A narrow deal that involves China purchasing more commodities, agreeing to intellectual property protections, and improving market access is more likely, at about 25%, but still leaves the tougher issues around national security, technology competition, and industrial policy unresolved. An agreement to pause hostilities is another option, but this should be seen as more of the same rather than progress. To be clear, the U.S. and China have hit the pause button twice already, only to see relations deteriorate further after the pause ended. It would mean the U.S. leaves tariffs in place at current levels rather than raising them or eliminating them, and would leave businesses to deal with ongoing uncertainty over the long-term state of relations and supply chains. Now, finally, I see a 40% chance that the tension between the U.S. and China actually escalates in the months ahead. This would involve failure to agree a resolution in October and would lead to increased tariff rates and further retaliation from China. Overall, the outlook is best characterized by uncertainty, but I would paint the backdrop for these scenarios as a negative one, given the bad blood that has been created in negotiations to date, and by recent commentary from the U.S. painting Xi Jinping as an enemy who is not to be trusted. Part of the logic from my negative perspective on the broader U.S.-China relationship is the national security concerns. Here we have provided 3 excerpts from the U.S. National Security Strategy in December 2017, a speech by FBI Director Christopher Wray in April of 2019, and a statement by the FCC Commissioner O'Reilly in May of 2019. I won't read the different statements to you, but what is clear from the excerpts is a consistent message of viewing China as a predatory thief of intellectual property with designs on using the pilfered insights to the detriment of the U.S. I would note as well in the third excerpt in particular that FCC Commissioner O'Reilly makes explicit that he, or perhaps more broadly the Trump administration, views companies in China as being agents of the communist government in China. In other words, unlike in situations with other countries where the U.S. clearly delineates between the government and private sector actors, it is clear that in the case of China, given its economic system, there is, quote, zero daylight, unquote, between the government and companies. This means all entities in China are likely to be viewed as the adversary rather than just the government. While these excerpts are particularly strident and might reflect a Trump administration perspective, I should note that the underlying concerns and skepticism regarding China's motives and long-term intentions are shared across the Republican and Democratic parties. This is a rare case of bipartisanship in Washington, D.C., and should be understood as likely to keep pressures high between the two countries, even if Trump does not win re-election. On the back of these rising suspicions, it is also clear that the broader U.S.-China relationship is suffering. Chinese foreign direct investment into the U.S. has declined by almost 90% from 2017 to 2018. More broadly, the share of Americans who view China and the U.S. as, quote, mostly partners, unquote, has declined by 35 percentage points. At the same time, the number of U.S. student visas issued to Chinese nationals has declined by 10% from 2017 to 2018, and anecdotal evidence indicates that tightening in access to U.S. universities has accelerated materially since 2018. So what does all of this mean to us as investors? First, the increased uncertainty around the U.S.-China trade relationship, not to mention the other major trading relationships with the U.S., has increased the risk of recession in 2020. Recession is not yet my base case scenario, but the risk is the highest it has been in several years. Also, don't overestimate the meaning of recession. This is not to say that we would expect another financial crisis. Instead, when I suggest the risk of recession has gone up, I mean the risk of 2 consecutive quarters of negative GDP growth, which may well be a shallow cyclical downturn. Keep in mind as well that any such recession would be starting from a point where unemployment is at a 50-year low and consumer balance sheets have improved materially. Second, trade-related uncertainty, to the extent it is not resolved in negotiations by year-end, is likely to keep central banks in accommodation mode well into 2020. My broader concern is that central bank infusions of liquidity, such as the recently announced 20 billion euros per month of securities purchases by the ECB, are likely to continue pushing up the value of financial assets, even while economic fundamentals continue to weaken. In light of these risks and the economic backdrop, I believe developed market duration and credit remain relatively unattractive. With over $15 trillion of government debt in negative yield territory and over $500 billion of corporate debt with negative yields, I believe it is more sensible to be invested in U.S. dollar cash balances or in emerging market debt where real yields are positive and where the currency risk associated with U.S. dollar strength has declined given the Fed's easing trajectory. Equities are not cheap, but they are certainly less expensive than debt. I continue to recommend an overweight equities position, but suggest de-risking within that overweight by focusing on companies that can sustain high returns on capital through enduring competitive advantages and strong balance sheets, but still trade at attractive valuations. Now, I recognize that the valuation part of that task is more challenging of late, but this is where security selection and deep forward-looking fundamental research are critical to making the right security selection decisions. There will be some sectors that are more vulnerable to the trade war. These sectors are likely to include consumer discretionary companies that will find it tough in some cases to pass through price increases if tariffs continue to be raised. The technology industry also might be in the bullseye in terms of non-tariff trade barriers. The challenge in this arena is that the restrictions could be very narrow and affect specific companies, or they could be quite broad, affecting semiconductors, for example, as a category. Beyond consumer discretionary and technology, a range of other companies and industries are likely to be affected when the two largest economies in the world clash and engage in a trade war. The key challenge is to focus on the actual cash flow implications for each individual company and to try to develop the best possible forecast of how the trade situation is likely to play out in the intermediate to long term to determine the appropriate implications for valuation. As always, our objective is to capitalize on our deep research expertise across our global sector teams to understand risk and reward across our opportunity set to the benefit of our clients. Thank you very much.